91%. Think about that number for a second. 91% of home builders looked at the landscape last year and said, yeah, high interest rates, that's our biggest problem.
It's a huge number. Really jumps off the page.
And looking ahead to this year, 2025, 78% still expect it to be a major issue. Meanwhile, you look at the national headlines, home prices are still kind of nudging upwards.
Yeah, it feels like a contradiction, doesn't it?
It does. It feels like a market straining under the weight of borrowing costs, for both builders and buyers. Yet somehow prices are holding firm or even appreciating in many places. It's a bit of a puzzle, isn't it?
Yeah.
What forces are really wrestling for control in the housing market right now? And how do the monthly numbers, like those released for new home sales, how do they give us crucial clues, even if they seem small on their own?
It absolutely is a puzzle.
Mm-hmm.
And it's one that requires digging beneath the surface. The housing market isn't a single, simple thing. It's this complex interplay of forces. You've got supply from builders, demand from buyers, the cost of money, regulations, even like regional economics playing a part.
Mm-hmm.
To truly understand it, we need to look at the hard data, listen to the perspective of the people actually, putting up the walls.
Yeah.
And maybe even explore the deeper academic research that models how these pieces fit together.
That's exactly our mission today. We're diving deep into the latest data on U.S. new home sales. We're going to hear directly through surveys about the persistent headwinds builders are facing.
Right, those challenges.
Then we'll take I think, a fascinating turn into some research that breaks down how interest rates and borrowing constraints fundamentally influence house prices and, the speed at which markets move.
The dynamics, yeah.
And finally, we'll zoom out a bit and see where housing fits into the broader economic cycle, using the sources you shared, data from the Census Bureau, insights from the NAHB, that research from the FHFA, and some economic context from Bankrate and the First Tuesday Journal as our map.
Absolutely. It's all about connecting the dots. You start with the raw sales and inventory numbers. That gives us the current pulse.
Yeah.
Understanding the builder challenges tells us about the constraints on future supply. The research helps us grasp the underlying physics, almost, of price movement in response to financing.
The physics. I like that.
And placing it in the economic cycle helps us see housing not just as a sector, but as, a leading or sometimes lagging indicator for other parts of the economy.
All right, let's jump right in then. Let's set the scene with the freshest snapshot of the market. The U.S. Census Bureau released its report on new residential sales for April 2025. What were the headline numbers telling us?
Okay, so the preliminary seasonally adjusted annual rate for new home sales in the United States, for April 2025, it came in at 634,000 units.
Okay, 634,000 units. How does that measure up against the sales pace we've seen in the past year or so, based on the data you have?
Well, looking back at the figures for the previous year, that 634,000 rate for April 25, it's actually quite a bit lower than most months we saw from, say, April 2024 through December 2024.
Really? Lower?
Yeah, those months were pretty consistently higher.
Yeah.
Often in the 700,000 range, like April 2024 was 719,000, July was 710,000, and December 2024 hit 718,000.
Wow.
Even October 2024 was 621,000, which is kind of close, but yeah, most of the other recent months were clearly above this latest figure. So on the surface, April shows a noticeable slowdown compared to the latter half of 2024 and early 2025.
A noticeable slowdown. But the Census Bureau always includes those important notes, right, about statistical significance and variability. How should we interpret that 634,000 number in light of those caveats?
Yeah, this is absolutely crucial context, and it's something the Census Bureau really stresses.
Yeah.
They state that reported percent changes have a 90% confidence interval.
Okay, what does that mean in plain English?
Right. So if the reported change is, say, 2.5%, plus or minus 3.2% above the previous month, the actual change is likely somewhere in that range.
Mm-hmm.
So from a decrease of 0.7% up to an increase of 5.7% in that example. Now, if that confidence interval includes 0,
okay.
then they officially state there's insufficient statistical evidence to say a real change actually occurred.
Gotcha.
The month-over-month change isn't explicitly given for April 25 in the text we have, but based on their typical variability, a single monthly movement, even one that looks like a dip from prior months, it might not be statistically distinct from 0. They note it generally takes about 3 months of data to really confirm a trend is happening. Plus, these preliminary figures, they're subject to revision. On average, preliminary estimates get revised by about 3.2% later on.
So, okay, the headline number is 634,000, and it looks lower than recently, but we need to treat it with caution. The actual change could be within the margin of error, and the number itself might even change later. It's less about the precise number then and more about waiting for a pattern to emerge over a few months.
That's the way to look at it. Don't get fixated on the specific 634,000 being drastically different from, say, 680,000 in just 1 month. Look for the trend.
Got it. Okay. What about the regional picture for April 2025 sales? Were there any standout areas, or was the slowdown pretty uniform across the country?
Well, the census data gives us the raw, seasonally adjusted annual rates by region for April 25. You've got the Northeast at 30,000, Midwest at 77,000, the South at 363,000, and the West at 164,000.
Whoa. The South is huge compared to the others.
Absolutely. The South completely dominates new home sales activity. It accounts for well over half the national total. And that's a consistent pattern you see if you look back at previous months in the table provided. While the excerpt doesn't explicitly give like month over month or year over year changes by region for this April, the stark difference in sheer volume across regions is always apparent. More new homes are simply built and sold in the South and West compared to the Northeast and Midwest. It's just a different scale.
So, big picture for sales in April. Potentially a slowdown, but caution is warranted due to data variability. And the South continues to be the engine of new home construction activity by volume. What about the other side of the coin inventory? How many new homes were actually for sale at end of period in April?
Right, inventory. At the end of April 2025, there were 488,000 new houses reported as being for sale.
488,000. And combining those two numbers, the sales rate and the inventory, that gives us the months of supply, right? What was that figure?
That's right. The months of supply in April 2025 stood at 9.2 months.
9.2.
Yeah. And this ratio tells you, hypothetically, how long it would take to sell off the current inventory if sales continued at April's pace. Now, it's important to contrast this with what's considered, balanced market for existing homes.
Okay, what's that benchmark?
The Bankrate source mentions that benchmark is typically around 5 to 6 months of supply for existing homes. New construction supply tends to be inherently higher.
Why is that?
Because it includes homes that are still under construction but not yet finished, not just completed homes sitting vacant. So 9.2 months.
Yeah, it's quite elevated. It indicates that relative to the current sales pace, there's a significant pipeline of new homes available or coming soon.
Okay, so sales looked a bit softer, and the supply relative to that sales pace is high at 9.2 months. What about how long homes are actually sitting on the market before they sell, the ones that did sell?
Good question. The median months for sale for new homes that did sell in April 2025 was 4.2 months.
4.2 months, so that's the midpoint.
Exactly. Half the homes that sold had been listed for less than 4.2 months and half for longer.
Got it. Okay, shifting gears slightly from the new sales data to the broader price picture. How does the national home price situation look right now? Are things still climbing?
Yeah, the Bankrate source gives us some figures here. Cotality reported that nationally, home prices rose 2.5% from March 2024 to March 2025.
2.5% year over year. Right. And their forecast is for that appreciation to pick up slightly, actually. They're forecasting a 4.9% increase by March 2026.
Interesting.
Yeah.
What about existing homes?
The National Association of Realtors, NAR, they look at existing homes. They reported their median sale price in March was $403,700. That was up 2.7% year over year.
And wasn't there something about how long that streak has been going?
Yeah, that 2.7% marked the 21st consecutive month that existing home prices saw a year-over-year increase.
21 consecutive months. Wow. So even with higher rates and all the affordability challenges, prices for existing homes are still climbing nationally, maybe at a slower pace than the peak frenzy years, but still climbing.
That's the picture the national aggregates paint, yeah.
Yeah.
But the Bankrate article quotes Selma Hepp from Cotality, and she notes that while national growth is slowing, some markets are proving resilient. Particularly, she mentions the Northeast and Midwest.
And why there? What's propping them up?
She attributes it to a severe lack of inventory, just not enough existing homes for sale. And that's helping to prop up home prices in those specific regions. So again, national numbers can mask significant regional differences driven by local supply and demand.
And this connects directly to the inflation numbers we keep hearing about, doesn't it? The cost of shelter.
Absolutely. Housing costs, particularly shelter, they're a huge component of the overall consumer price index, the CPI, which is our main measure of inflation.
Right.
According to Bankrate, Referencing the Bureau of Labor Statistics data, shelter costs increased 4.0% in the 12 months leading up to April 2025.
4%. It's
Yeah.
still pretty high.
It is. It remains, as Mark Hamrick at Bankrate puts it, the jumbo heavyweight of inflation.
Yeah.
Even as the overall CPI increase has ticked down slightly to 2.3% over the same period, shelter costs are keeping that overall number higher than it might otherwise be.
Okay, so let's try and put this all together for the current scene then. New home sales in April looked softer than recent history, maybe, but we need caution interpreting 1 month's data.
Right. Need to see the trend.
New home supply is relatively elevated compared to sales pace. Existing home prices, though, are still appreciating nationally, especially where existing inventory is tight, like the Northeast and Midwest. And that's contributing significantly to overall inflation via shelter costs. That's the backdrop.
Okay, now let's pivot to the people who actually build these homes. The NAHB survey gives us their perspective, and it sounds like they're facing some pretty intense challenges.
They absolutely are. Yeah, the NAHB's Eye on Housing survey provides a really crucial window into the operational realities for builders. When they were asked about the most significant problems they faced in 2024, one issue stood head and shoulders above the rest: high interest rates.
That 91% figure again.
A staggering 91% of builders cited this as a significant problem.
91%. That's not just a problem. That's like a crisis point for the vast majority of the industry.
Yeah.
And you mentioned earlier, 78% expect it to continue being a major problem this year in 2025. Precisely. It's a dominant, persistent challenge. And for builders, look, this isn't just about buyer affordability, though that's part of it. It's also about the cost of their own construction loans.
Ah, right. Their financing costs.
Exactly. Those often have variable rates tied to the prime rate. So higher rates make financing projects more expensive, riskier.
Yeah,
It could potentially delay or even cancel planned homes.
makes sense. Beyond just interest rates, what other major headwinds were builders battling in 2024? What else was high on their list?
Okay, the other top challenges reported by a large majority of builders in 2024. You had rising inflation in the U.S. economy generally. That was 80%. Then buyers expecting prices or interest rates to decline, basically. Hesitant buyers, that was 77%.
That's interesting. Buyer psychology itself is a challenge.
Big time. Then you had the cost and availability of developed lots at 63% and the cost and availability of labor at 61%. So it's this mix of financing costs, general economic conditions affecting costs and buyer sentiment, and then the fundamental inputs of building land and people.
And how do they see those other challenges evolving in 2025? Are they expecting relief on any of those fronts?
Well, for 2025, the outlook is slightly better on some things, but not others. Fewer builders expect inflation to be a major problem. That drops down to 52%.
Okay, that's something.
And concern about the overall employment or economic situation also drops down to 39%. However, the cost and availability of lots and labor, those are expected to remain significant challenges. The percentages stay stubbornly high, pretty similar to 2024 levels.
So land and labor bottlenecks aren't really easing up in their view.
Doesn't look like it. And interestingly, concerns about building material prices are actually expected to increase in 2025. That rises from 57% citing it as a problem in 2024 to 64% expecting it to be one in 2025.
Material prices going up is a concern. That seems a bit counterintuitive if overall inflation is expected to ease.
It does, yeah. But it highlights that maybe certain sector-specific costs, perhaps for key building components, remain volatile or high for builders, even if the overall CPI trend is looking a bit better. Also, fees, things like impact fees, hookup fees, inspection fees charged by local governments, they remain a problem for a consistent majority. That was 55% in 2024, expected by 58% in 2025. These are costs that are often hard for builders to control, and they add significantly to the final price of a home.
Right, the soft costs. It's helpful to see the percentages, but the historical context you mentioned really brings it to life. How do these challenges compare to, say, 5 or 10 years ago? Were builders always worried about rates this much?
Oh, the historical data from NAHB is incredibly telling on this. Take high interest rates before 2022. This was basically a non-issue for builders. It was cited by fewer than 10% for years.
Less than 10%.
Yeah. Then bam, 66% in 2022, 90% in 2023, 91% in 2024. That chart, if you plotted it, is practically a vertical line showing the impact of the Federal Reserve's rate hikes on the industry. Rising inflation followed a similar, though maybe less dramatic path. It jumped from 63% seeing it as a problem in 2021 to the 80% plus range in the years since, and buyers expecting prices or rates to decline. That's also a pretty recent phenomenon, barely on the radar before 2022, then it shot up to nearly 80%.
So high rates, general inflation, and skeptical buyers. Those are relatively new, intense pressures driven by the big economic shifts we've seen recently. What about those perennial problems like finding land and labor? Have those always been tough?
Those have been grinding challenges for much longer, yeah. The cost and availability of developed lots.
Yeah.
This has been a serious problem for over half of builders in 9 of the last 14 years. It actually hit a record high of 63% in 2024, tied with 2019. So access to buildable land that's permitted and ready to go, it's a fundamental bottleneck.
A long-term structural issue.
Exactly. And the cost and availability of labor. That's been a serious issue for over half of builders for 11 consecutive years now. Though it has eased slightly from the peaks of 85% back in 2021, 2022, down to 61% in 2024. But still, finding skilled tradespeople has been a persistent structural challenge in the industry for over a decade.
Okay, this paints a really vivid picture of the headwinds. High interest rates are like the big new storm hitting the coast.
Yeah.
But they're hitting an industry that was already struggling with these long-standing issues, like finding land and labor. And all of this, if it directly impacts supply, doesn't it?
Absolutely. These aren't just abstract survey numbers. They translate directly into the ability and the willingness of builders to put shovels in the ground.
Right.
If land is scarce and expensive, if labor is hard to find and costly, if materials are unpredictable in price, and crucially, if the cost of financing the entire project is prohibitively high, well, builders simply can't or won't build as many homes. This constrains the supply of new construction, which in turn affects the overall market dynamics. And those inventory levels we saw in the census data, like that 9.2 months of supply figure, it's a direct line from builder challenges to market conditions.
This brings us neatly to the more theoretical side, maybe, but it feels crucial for understanding how these factors actually influence prices. We know interest rates matter, obviously, but the research you shared from the FHFA, it digs into the specific mechanisms, right?
Yeah, it does.
What was the core question that research was trying to answer? And what did they find about how rates affect house prices, maybe in ways we don't always think about?
So the FHFA research, it really tries to go beyond that simple observation that, higher rates mean lower prices, eventually. They wanted to understand the channels through which mortgage interest rates influence house prices, looking at both the long-term fundamental values and also the shorter-term dynamics of how markets adjust. And their key finding, really, is that rates impact prices not just directly, but also indirectly by interacting with borrowing constraints. And these effects, importantly, vary depending on the market's condition and its location.
Okay, so it's not just A causes B. There are layers involved here. And one of those key layers involves borrowing constraints. The paper focuses a lot on debt service to income, or DTI. Let's just make sure we're clear on what that is.
Right, DTI. It's a critical concept for understanding borrower capacity. It's basically a simple ratio, the total of your monthly debt payments.
Including the potential mortgage?
Yeah, including the potential mortgage payment, property taxes, homeowner's insurance, plus any other recurring debts like student loans, car payments, credit cards, all that divided by your gross monthly income.
Okay.
Lenders use this to assess your ability to manage more debt. And in the U.S., regulations like the Qualified Mortgage, or QM, rule often set thresholds. 43% DTI is a common cap for prime mortgages. It's not always an absolute hard limit. Sometimes you can go higher, but maybe pay a higher rate for the risk.
Yeah.
But it creates a pretty strong barrier for many borrowers.
So DTI is essentially a measure of how stretched your income is by your existing debt, plus the potential new mortgage. How does a change in interest rates directly impact that DTI calculation and therefore how much someone can borrow?
Yeah, this is where the math becomes really clear. Let's use a simple example from the source material. Imagine someone has a fixed amount they are comfortable or able to pay each month towards a mortgage payment, let's say $2,000.
Okay.
If the interest rate is 3%, that $2,000 payment can support a much larger loan amount. Hypothetically, they use an $800,000 interest-only loan in their example for simplicity.
Right.
But if the interest rate jumps to 4%, that same $2,000 payment can only support a smaller loan, maybe $600,000 in their example. Or, another way to look at it, say you have $100,000 in income and you hit a 40% DTI limit. That sets your maximum total monthly debt payments. At a 4% mortgage rate, you might be able to borrow up to, say, $1 million because the payment fits within that DTI limit. But If the rate goes to 5% or 6%, the same income and the same DTI limit mean you can afford a significantly smaller mortgage amount. The payment on the $1 million loan would push you over the DTI threshold.
I see. So higher rates mean that for any given income and any given DTI limit, the absolute dollar amount you can borrow just shrinks. It directly reduces buyer purchasing power.
Exactly. That's the direct impact. And the research found that higher mortgage interest rates are directly correlated with a larger share of borrowers in a given city hitting those high DTI limits, specifically at or above that 43% threshold they focused on.
So more people get pushed up against that ceiling.
Right. While they use specific statistical measures in the paper, the takeaway is clear. Pushing rates up directly pushes more potential buyers into a constrained category where their debt load relative to income limits how much they can borrow, regardless of the actual price of the house they want.
Okay, so higher rates constrain more borrowers by pushing them against their DTI limit. Now, how does the share of constrained borrowers in a market combined with interest rates actually influence house prices according to this research?
Okay, so the researchers identified a few different ways this happens. First, there's this straightforward long-run effect. Interest rates are a fundamental cost of home ownership. So lower rates make housing more affordable for a given income level, which, all else being equal, increases the theoretical long-run value of housing.
Makes sense.
Conversely, higher rates reduce that fundamental value over the long term.
Okay, that's at the long run. What else?
Second, and this is perhaps the most complex and I think interesting finding, is the speed of adjustment effect.
Okay.
They found that the fraction of borrowers in a city who are hitting those DTI constraints, that influences how quickly actual house prices move towards that long-run fundamental value we just talked about. And they found something really fascinating and asymmetric here. When house prices in a city are below their estimated fundamental value, meaning they seem kind of undervalued based on economic factors,
Right.
they tend to slowly appreciate and adjust upwards over time anyway, at a pretty steady rate, regardless of how many borrowers are constrained. It's like the market naturally finds its way up.
So undervalued markets tend to self-correct upwards slowly, no matter what's happening with borrower constraints.
Basically, yes, according to their models. But here's the twist. When prices are above their estimated fundamental value, potentially overvalued, they found that prices don't seem to adjust downwards toward that fundamental value unless a large enough share of borrowers in that city are hitting those DTI constraints.
Oh, wow. Really?
Yeah, it's like the payment constraint acts as a brake on overvalued prices, but only if there's sufficient pressure from a significant number of buyers who simply cannot stretch their budgets any further because of the DTI math.
So the constraint forces the issue when prices get too high.
It seems that way. If there aren't enough constrained buyers, overvalued prices might just stay high for longer. But when there are enough constrained buyers, they threw out a number like maybe 27% or more, hitting DTI 43% in their model. It can actually accelerate the downward adjustment towards fundamentals when prices are elevated.
Wow. So constraints matter most when prices are high. They act as a mechanism to pull potentially overvalued prices back down, but only if enough people are feeling that financial squeeze. That gives borrowing limits a really powerful role in market corrections, potentially.
Exactly. It adds a layer of nuance beyond just saying demand falls when rates rise. It suggests demand falling specifically because the ability to finance the purchase hits a regulatory or lender-imposed wall via DTI. And that specific constraint seems key to bringing elevated prices back in line with fundamentals.
Okay, so there's the long-run effect and the speed of adjustment effect linked to constraints. Was there anything else?
Yeah. Third, there's also a short-run effect. This found that quarterly changes in interest rates can have a small, almost immediate impact on house prices in the very next quarter. But they noted these quarter-to-quarter movements can be pretty noisy and aren't really the main driver of big price shifts.
Okay, so a little immediate blip, maybe. So we have a long-run effect on fundamental value, a speed of adjustment effect driven by borrower constraints, especially when prices are high, and this tiny immediate effect. What does the total impact look like over time from a sustained change in interest rates, putting all those pieces together?
Right. The total effect is the sum of these channels, and it really accumulates over time. They gave an example calculation. A permanent increase in mortgage rates, roughly equivalent to moving from 4% to 5%. Well, that might result in a very small price change after just one quarter in their example, maybe a decrease of around 0.7%. Tiny.
Okay.
But the estimated long-run effect of that same rate increase is much, much larger, potentially a decrease of over 10.7% in their model.
10%.
Yeah. The big impact isn't immediate. It builds over years as prices eventually converge to the new, lower fundamental value that the higher rate environment dictates. And that convergence speed is influenced by those constraint dynamics we talked about.
And you mentioned this is also location specific. The impact isn't the same everywhere. That seems critical.
That's a crucial point. They emphasize heterogeneity across cities. The research suggests the impact of interest rates is strongest in areas that have two characteristics simultaneously. First, housing supply constraints.
Meaning it's hard to build new houses there.
Exactly. Places where it's difficult to build more homes due to things like restrictive zoning, tough land use regulations. They even reference specific indices that measure this, like the Wharton Land Use Regulatory Index.
Okay, supply constrained. What's the second characteristic?
The second is a high share of payment-constrained borrowers. Cities where many potential buyers are already hitting those DTI limits we discussed.
Why does having both make the market more sensitive to rates? What's the connection?
Well, think about it. If a city has really tight building rules, you can't easily increase supply to meet demand. So prices are naturally more sensitive to shifts in demand.
Okay.
If, on top of that, a lot of people in that city are financially stretched to the absolute limit by the current rates, then even a small further increase in rates pushes a large portion of the potential buyer pool completely out of the market or significantly reduces how much they can offer.
Right, they have no more room to stretch.
Exactly. And with constrained supply, unable to absorb that drop in potential demand by just building more units, the downward pressure on prices is much greater than it would be in a city where land is plentiful, building is easy, or maybe buyers generally have lots of financial wiggle room and aren't near their DTI limits. Their findings, which they illustrated conceptually in one of their figures, suggest that maybe a 0.25% rate increase playing out over 3 years might have a relatively small cumulative impact in a market with elastic supply and unconstrained buyers, but a much larger, more significant negative impact on prices in a market that suffers from both supply and credit constraints.
That makes so much sense. It's the combination of not being able to build more and buyers hitting their financial ceiling that makes a market particularly vulnerable to rate hikes. National averages really do hide a lot of local reality, don't they?
They really do. And you see how it links the builder challenges. We talked about the cost and availability of lots, the impact fees, all contributing to supply constraints, with the buyer challenges of high rates hitting DTI limits, all framed within this research. It connects the pieces.
Okay, fantastic. We've covered the latest data, the view from the builders, and this really insightful research on the deeper mechanics of how rates and constraints function. Let's zoom out one final time now. Where does housing activity, specifically new home sales, fit into the larger rhythm of the economy? Is it a leader, a follower?
Yeah, the First Tuesday Journal source provides a helpful perspective on this. They really stress housing's significant role. New home sales are particularly important because, unlike existing home resales, they represent new production.
Right, something actually being built.
Exactly. And so they're included as a component of the gross domestic product, or GDP. Beyond just that direct contribution, real estate and related industries can make up a substantial portion of economic activity. In many states, they mentioned California's real estate-related sectors contributed something like 17% to the state's economic activity back in 2008, just to give a sense of scale.
Wow, 17%. That's huge.
It is. Now, they describe a kind of standard economic cycle where changes tend to move sequentially. Generally speaking, changes in GDP tend to lead changes in employment, often within about a 12-month time frame.
Okay, so economy moves first, then jobs follow.
Right. Then real estate sales volume and things like rental occupancy rates usually follow the direction of those employment trends.
Okay, so economy, GDP moves first, then jobs, then the volume of housing transactions seems to follow jobs. What about prices in that cycle?
This is where housing gets a bit more complex and sometimes has a leading role. They point out what they call a countercyclical lid, specifically for home sales volume.
Countercyclical lid.
Yeah. Historically, changes in the volume of home sales tend to occur before significant adjustments in home prices, often by about 9 to 12 months.
So sales volume moves before prices.
Tends to, yeah. And home sales volume itself tends to lead changes in GDP by an even longer period, roughly 24 months or so.
Wait, so if we see home sales volume consistently picking up, that might signal that home prices will start accelerating roughly a year later. And maybe broader economic growth, GDP, will strengthen about 2 years after that initial sales volume pickup.
That's the historical pattern they've observed, yes. It suggests that activity in the housing market, especially the transaction volume, can be an early indicator for both price trends within housing and economic trends more broadly down the road.
That's fascinating.
They do add the important caveat that market distortions, like the significant mortgage deregulation that happened leading up to the 2008 crisis, can sometimes skew these typical relationships. So it's not an iron law, but a historical tendency.
Okay, so how do the current data points we've discussed today fit into this historical cycle framework? We saw that potential dip in new home sales in April, for instance. What might that suggest, if the pattern holds?
Well, if we take that historical lead pattern seriously, a sustained dip in sales volume, like the one we possibly saw starting in April, we need to watch future months to confirm it's a trend.
Right, the caveats.
That could potentially signal slower price growth or even future price adjustments in housing, maybe 9, 12 months down the line, and possibly slower GDP growth even further out, maybe around 24 months from now. We also noted in the Builder survey that concerns with the overall employment to economic situation, while easing a bit for their 2025 outlook compared to 2024, are still present. That kind of aligns with the cycle idea that employment follows GDP changes.
Yeah.
And the fact that shelter costs, driven by housing prices and rents, remain a major contributor to CPI that keeps housing firmly linked to the current inflation and overall economic picture. So it's a way to try and understand the current snapshot within this larger moving system.
This framework really helps connect the micro data, like 1-month sales report, to the much bigger macro picture.
Yeah.
Okay, so after delving into all this, the numbers, the builder struggles, the research mechanics, the economic cycle, what does this all mean for someone who's listening right now, maybe trying to navigate this market, considering buying or selling a home? Let's bring it down to the individual level.
Yeah, absolutely. For potential buyers, I think this deep dive reinforces what many are already feeling out there. The Bankrate source noted that, 77% of consumers surveyed back in April 2025 felt it was a bad time to buy.
77%, that's a lot of pessimism.
It is. And that feeling really comes from the combination of these persistently high prices, especially for existing homes that we talked about, and the high interest rates, which together make the monthly payment significantly higher than it would have been just a few years ago for the same priced house.
Right. It's the monthly cost that hits hardest for most people, and rates plus prices are what drive that number way up.
Exactly. And as a buyer, you're often facing a market with very low inventory for existing homes in many areas, particularly as we heard in the Northeast and Midwest. That keeps competition stiff and puts a floor under prices there. Now, on the new construction side, the census data showed that higher months of supply figure 9.2 months.
Right, the higher inventory there.
So that might mean more options if you're open to new builds, maybe in locations where builders are active. You might face less intense bidding wars than you would on a popular existing home in a prime neighborhood.
So maybe a bit more breathing room looking at new construction, potentially. Okay, so if someone has to buy now, maybe life circumstances dictate it despite the challenges, what practical steps can they take based on these sources? Any advice jump out?
Yeah, the Bankrate source offered some solid advice for navigating a tough market. One kind of silver lining of higher interest rates generally is that you can earn more on your savings.
True.
So they suggest keeping your down payment funds in a high-yield savings account or maybe a money market fund until closing. Just be mindful of the time it takes to access those funds when you need them.
Good point.
Also, really shop around for mortgage lenders. Many non-bank mortgage companies might not charge the typical 1% origination fee that traditional banks sometimes do, and that can save you thousands right off the bat.
Worth checking out.
Definitely. And crucially, once you get an interest rate you're comfortable with, lock it in. Rates can be volatile, especially during the closing process, and locking protects you from unpleasant surprises, last-minute increases.
Lock it down. Okay. What about the big question? Should people wait, hoping things get better, or just jump in if they need to?
The wait or buy dilemma, yeah. Greg McBride at Bankrate weighed in on this. He made a good point. Falling inflation doesn't mean prices are falling. It just means they're increasing at a slower pace.
Right. Deceleration, not depreciation.
Exactly. This could, over time, allow incomes to catch up and maybe improve affordability. But as he says, there are no guarantees. The market could stay like this for a while, or rates could even go higher. Who knows? So if you need to buy because of life events, a new job, growing family, whatever the conventional wisdom, reinforced here, is to buy with the intention of staying put long enough to build equity and ride out potential shorter-term market fluctuations. Don't bank on flipping it quickly in this environment.
Plan for the long haul if you buy now.
Okay.
And what about for sellers? The low existing home inventory we talked about, That sounds like it could be a real advantage for them, right?
It can be, absolutely.
Mm.
If you have a well-maintained existing home in a desirable area where inventory is low, you likely have some leverage. Demand is often strong, which can lead to multiple offers and potentially selling at or even above your asking price.
So it sounds like a great time to sell then.
It can be a good time to sell, but here's the critical caveat, the other side of the coin.
There's always a catch.
Well, unless you're leaving the housing market entirely, maybe moving into a rental, or moving overseas, you're likely selling one home only to buy another in the exact same market.
Oof, right.
So, yeah, you'll be selling into strong demand and potentially high prices, which is great, but then you'll immediately be buying back into high prices and facing those same high interest rates yourself on the purchase side. It solves one problem, but creates another. And remember that point from the research about heterogeneity and the regional sales and price data we saw? Your specific experience as a buyer or a seller will be heavily influenced by your local market conditions.
Back to real estate is local.
Always. How much inventory is actually available in your specific neighborhood? What's the economic health of the local buyers? What types of homes are being built nearby, if any? What are the specific supply constraints in your city or metro area? The national picture gives us context, but the local reality is what dictates your outcome.
That's a perfect summary point. Real estate is famously local. Wow, we've covered a lot of ground today, from the pulse check with the census data to the builders' persistent pain points.
Yeah, those headwinds.
To that really deep dive research on how rates and constraints uniquely impact price movements. And finally, how housing kind of fits into the broader economic cycle.
The overarching lesson, I think, is that understanding this market really requires looking at the whole system. It's not just rates or just inventory or just builder costs in isolation. It's how high interest rates interact with builder capacity. There are challenges with labor, materials, land, their own financing to affect supply, and how those same high rates simultaneously hit buyer affordability and borrowing constraints like DTI to affect demand. And then how these forces play out differently depending on local supply constraints and the financial situation of local buyers, with effects that aren't always immediate but tend to unfold over months and years.
That complexity is fascinating, but also maybe a bit daunting. So to leave our listener with something to ponder, building on this deep dive, what's a thought that might change how they look at housing news or their own situation going forward?
Well, okay, given that the research really highlights how the impact of interest rates and borrower constraints isn't uniform across cities.
Okay.
It's the largest where supply is constrained and buyers are financially stretched. And given that house prices can take multiple years to fully adjust to fundamental values, maybe only accelerating downward adjustments when prices are high and a lot of borrowers are constrained, how might knowing this change how you react to the next big national boom or bust headline you see?
Good question.
Instead of just looking at whether national prices are up or down 2%, what micro-level indicators in your own city or region might you start watching to get a clearer, maybe more nuanced picture of what's really happening on the ground where you live?
What kind of indicators?
Well, think about things like local inventory trends, not just national, but in your zip code or county. Look at local building permit activity. Are builders pulling more permits or fewer? Maybe even keep an eye on local income growth trends. Or on the downside, local foreclosure rates. The national story is important context, but the local details are often where the true dynamics reveal themselves first.
That's a powerful shift in perspective, moving from just consuming the national noise to actively looking for the local signal. A great call to action for deeper, more informed thinking. Thank you so much for guiding us through this complex but really crucial topic today.
My pleasure. It's a market that touches pretty much everyone. And the more we can understand its underlying mechanics, the better equipped we hopefully are to navigate it.
And thank you all for joining us for this deep dive. We hope it's given you a more robust framework for understanding the forces shaping the U.S. housing market right now. We'll be back soon with another deep dive into a new stack of sources.
Until then, keep questioning, keep exploring, and keep digging for knowledge.